Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger and Associates Financial Planning. I'm pleased to have with me today Mackensie Ellis, who's the manager of student loan development at Juno. Mackensie, thank you very much for joining me.
Yeah, thank you so much for having me. I'm excited to take a deeper dive into student loans.
Terrific. And for those of the viewers who don't know this, which is everybody, we actually recorded this. And when we went to pull it up, Zoom didn't record it. And we both recorded it and neither of us had it. That makes me very happy. But I'm happy to see you again, Mackensie. And I got to imagine that the next time we do this, which is this time, we're going to do even a better job.
I was going to say, we had a good run through.
That is correct. So this is going to be a two-part episode. What we're going to be doing is talking about the different types of student loans. We're going to kind of make it following a natural progression. The first is going to talk about what Mackenzie's company does. Then we're going to move into the types of student loans. And then we're going to start moving into repayment options upon graduation, refinancing, and all along that nature. And then additional strategies, recommendations, and everything else. So for starters, Mackensie, tell us what you do and what Juno does.
Of course. And like I said, thank you so much for having us again. We're always happy to be here. So Juno, and so going back, my name is Mackensie Ellis. I work as a manager over here at Juno on our student loan business development team. And my day-to-day is more just so doing things like this. But in terms of Juno, we help with student loans. We take a very holistic approach and comprehensive approach to student loans. We offer free one-on-one consultation calls with one of our student loan experts, just going over every single option available to each borrower. Everyone's situation is going to be so different, as we're going to learn today. And there's a lot of options out there, which can be very, very overwhelming for borrowers, especially borrowers coming out of school and they're like, I have all of this debt and I have not a single clue what to do with it. And Department of Education doesn't really help you a ton. So we're happy to educate you on what you have, your repayment options, and really help you save some money in the end.
Perfect. That's terrific. And for what it's worth, I've referred people over to Mackensie and Mackenzie's team, and I've actually been on calls, and they do an absolutely wonderful job. So I can't say enough about the work that you and your team have done. So thank you very much for assisting clients and people who have approached us. So tell me about the different types of loans. And let's start off real easy. It's public and private. So tell me a little bit about it.
Absolutely. So when we're talking about student loans, the umbrella term will be student loans, and then there's two subdivisions. It's going to be a federal student loan and a private student loan, and it really just boils down to those two. Now, from there, federal student loans have different branches, I will say. So federal student loans have different subdivisions. There's a direct subsidized, direct unsubsidized, a grad plus, and a parent plus. So federal student loans have different buckets under it. A private student loan has none of that. A private student loan is just a private student loan. I'll get to a private student loan in 1 second. So with those federal student loans, I'll go over each one in a little bit more detail. So with federal student loans, that's going to be where you go for that federal aid. You're completing the FAFSA application. You're going to do that application, get your federal aid, see what you receive. The options that you can potentially get, as I mentioned, are going to be those four that I said. And with that, the best option that you could get is a direct subsidized loan. That one we always say max out on. Why it's so great is because one, it is going to have the lowest interest rate for any federal student loan always. Federal student loan interest rates, they do change every July 1st. So they're not always the same every single year, but they will, subsidized direct loans will always have the lowest of the bunch. Thing with subsidized loans though, you can only get it for undergrad, so you can't get it for grad school or med school, dental school, anything like that. Only for undergrad, and it's all need-based. So what that means is when you complete the FAFSA application, they deem you, eligible if you meet a certain criteria or don't meet a certain criteria, I should say, or threshold, and that makes you basically need-based. Thing with subsidized loans, they are capped, which means they usually cap it $5,500 per year. And as we know, college is a lot more expensive than that. So you do have to seek aid elsewhere. So that's going to take me to my second one. It's a unsubsidized loan. Unsubsidized is still a great loan to have. We always say max out on unsubsidized because with unsubsidized, that also has the same interest rate as the subsidized. So still very competitive interest rate. The thing with unsubsidized, though, you can have it for undergrad, grad school, med school, anything like that. You can get an unsubsidized loan as well. One thing I didn't mention that I forgot to mention as well, subsidized, going back to subsidized. Subsidized means you do not have to pay interest or any payment on that loan until after grace period. Grace period is 6 months post graduation. So you don't have to pay interest. It does not start accruing until after you graduate, 6 months after. So that's subsidized. Unsubsidized is the opposite. So as soon as you take out an unsubsidized loan, you start accruing interest the day you take it out. So the loan is going to be growing as the child is going to college. Both are still incredible to have. Max out on both. The unsubsidized is not need-based. Most borrowers are going to get it. It's still capped pretty much at the same amount as a subsidized. And even those together, as we know, still is not covering the entire cost of the tuition, which is insane. So that brings us to the plus loans. Those are grad plus, parent plus.
Can I ask you a question?
Yes, of course.
So in the event that, let's say, someone's tuition is covered, but not the room and board, can the Stafford loans, the subsidized and unsubsidized, that's Stafford, correct?
Correct. Yeah.
That's just the other term for it. So can the Stafford loan only be used for tuition, or can it also be used for room and board?
Can be used for room and board as well. Anything that pertains books, room and board, anything like that can be any of those federal student loans can do.
And my understanding too is that they're not actually issued at $5,500. It's $2,750 first semester, $2,750 second semester.
Exactly. Yep. So it does break apart, but unfortunately, even so, still doesn't not it covers a decent bit, but nothing substantial.
So now the other thing too is that a student needs to apply for this every year, correct?
That is correct. Yes. So student who is in need of any type of student loans for the next upcoming semester or year has to complete the FAFSA application, and therefore that's where they'll get their aid. But they do have to do it every single year.
So it seems to me that, obviously $5,500, if I remember correctly, is it $5,500 freshman year, $6,500 sophomore year, and it's $7,500, something like that?
Correct. Yeah, exactly.
The reality of it is that, show me a school that's under $7,500 and I'll be happy. So the reality of it is that at a minimum, a student's going to have to get 8 loans, right? I mean, if
Minimum.
college is $50,000 a year, I'm going to get a $5,500 Stafford loan, whether it's subsidized or unsubsidized. You said it's the best loan rate, but then I'm still going to need to get the rest of it, which is another loan. And if I'm doing this every semester, I am getting actually not 8 loans, potentially 16. Or are they issued for 1 year, but only dispersed every semester?
So exactly like you said in the first segment. So you basically get a new student loan every single semester. So people do come out of undergrad. The average is about 20 different student loans. I'd say between 15 and 20 different student loans, just with all of the funding needs. And that's a different type of loan. That's a different interest rate every year, sometimes a different loan servicer. Even though federal student loans, federal student loan's a federal student loan, you can have different federal student loan servicers. So that's a lot of student loans to keep track of when you graduate. And you're like, okay, I have to pay this one to this one and this amount to this lender. It's a lot to keep track of.
No kidding. Sounds like it. So you referenced July 1st is the change in interest rates. Is the interest rate assessed to the loan or applied to the loan or whatever you want to use the term? Is it at the time of application or at the time of disbursement? Meaning that if I said, oh my goodness, we're in a rising interest rate environment, of which kids aren't thinking this, but I am. But if I were in a rising interest rate environment, I want to try to secure my loan before July 1st, right? Or doesn't it matter because they're going to be dispersing it in August anyway?
Exactly. They're going to be dispersing in August anyway. So I don't want to say it doesn't it's, doesn't matter if you're trying to be proactive. It's kind of just when the university is going to request the loan.
Okay. So in other words, I'm going to get whatever the August rate is, which is after July. Okay.
Yeah, absolutely. Unless you're doing a summer semester, then it makes it a little bit different. That throws a different wrench into it just because obviously university will need it in like May or something like that. But for the fall semester, yeah.
All right. So I derailed you. We talked about the Stafford loans, the subsidized and unsubsidized. Now you've got would you say the Parent Plus and the Grad Fit?
Plus loans.
Grad Plus, Parent Plus and Grad Plus. So tell me about them. I guess Grad Plus is for grad students, right?
Correct. So I'll start with Parent Plus and then I'll move to Grad Plus. So basically, as I mentioned, just to recap, we're going to tell you max out, subsidize, unsubsidized. Those are great loans to have max out. As we know, not covering everything. So that's when we're picking, okay, that's when you have a few decisions. You're like, am I going to get a plus loan? And I'll go over those in 1 second. Or am I going to take out a private student loan? And I'll go over both of those. So if you're going down the road of the plus, it's a Parent Plus or a Grad Plus. Parent Plus is exactly what the name entails in the parent's name only. So even though it is paying for the child's tuition, it has not a thing to do with that child. When it falls down to it, it is in the parent's name. Therefore, they are responsible to repay it. Therefore, it is their responsibility. We get a lot of people at Juno where they're like, oh, like I have a Parent Plus loan, but Megan's paying it, so I'm not worried about it. And it's like, okay, but if the child misses a payment, late payment, something happens, it's going to fall back on that parent. So they have to be okay with that when they're taking out that Parent Plus loan. I will also mention with a Parent Plus loan, it's an uncapped amount, which means it can cover the rest of the tuition if that's something they want to do. The kicker is it has an extremely high interest rate. So I said subsidized and unsubsidized have the lowest. Plus loans are on the other end of the spectrum. They have the highest. They're this year just shy of 10%. That's crazy. That's insane. That's a really high interest rate.
Higher than private.
That is higher than private, yes.
So I guess this always continues to raise the question, obviously students are taking out these loans because they need the money. In today's college cost environment, let's just call it $200,000 over 4 years. That's middle of the road. It's lower end on the private institutions, above the state schools, but still, let's just, for the sake of argument, call it 200,000. The reality of the situation is, if they wanted to go down the path of a Parent Plus loan, a lot of parents may not qualify. Whether they have bad credit or they don't have enough income, that forces them to go the private loan route, correct?
They could, yes. So usually with a Parent Plus loan, I don't want to say sadly, they do a credit check, but it can be truly any amount of credit. I've been in the student loan world for about, I'd say 10 years now. We've never seen anyone get declined on a Parent Plus loan. They're happy to give them out as long as you're willing to take it out. And that's just on the federal side. And that's kind of one of the advantages of the federal student loans, where they're like, we understand not everyone's perfect and you need to pay for school somehow. So they're a little more lenient on the federal side than the private side.
Okay, fair enough. And therefore you pay more interest for it. And so now let's talk about the private. You know what? I think we're at a really good breaking point right here, because I know we can really get into the private stuff. Let's kick that, because right now we need to take a short break. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger and Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back. We just left off talking about the federal student loans, and we're going to go talk about private. Now, I know we skipped the Grad Plus. We're going to come back to that because I'm focused right now. My head is on because the majority of loans are undergrad. Is that a fair assessment?
So depends where they're going. So med school, I'd say, heftier loans, bigger sums, but less loans. So yes, that would be an accurate statement.
So now I'm applying, my students and my child's applying, whatever the case may be. We clearly go after Stafford. Unfortunately, that represents a small fraction of what the total dollar amount is. We could subsequently go with the Parent Plus loan, which is the federal program. They'll give it to anybody as long as you can fog a mirror. That's our joke around here. If I can breathe and then I'm going to get a loan. Okay. But at a very high interest rate, well, guess what? If I don't want to pay the high interest rate, then I'll go the private route. But once we get done with that, I really want to understand the pros and cons, because I can think about the Fed has some cool things that private loans do not have. But let's talk about private loans. So now I don't want to go with the Fed loan because you said it's 10%. So now I decide to go the private route. Talk to
Of
me.
course. Yeah, so private student loans, like I said before, have no subcategories. A private student loan is just a private student loan. Just as some examples, your Discover loans, your Sallie Mae loans, your PNC Bank loans, any lender, any bank down the street, any credit union, that'll be a private student loan. SoFi, for example. There's a lot of names out there. There's a lot of different private student loan lenders. So private student loans are not owned by the Department of Education. As I mentioned, they're owned by private lenders. So they have nothing to do with the FAFSA application or federal aid or Department of Education. Private student loans, though, typically, as I mentioned, fall right in the middle of the plus loans and the unsubsidized and subsidized loans in terms of interest rates. So really depends what you're looking for. Like I said, some people are like, which we'll get into pros and cons, are like, I just want to stay on the federal side, even though I'm paying a 10% interest rate. Other people are like, get me the lowest interest rate. And then they're like, I'm just going to go the private side. So private student loans, you just get by applying on the bank credit union's website for the specific amount that you need. With it, the borrower will probably, since they are an undergrad, will need a cosigner of a parent, aunt, uncle, anyone who's willing to cosign and has a decent credit score can cosign for them. So we chatted about this prior, Mike, how, if a child does not have like someone willing to co-sign for them, unfortunately, they can't get a private student loan. So therefore, they would have to figure out a different method. But
I'm lost now. So if a student doesn't have someone that's willing, they're out of luck, because they can maybe get the Stafford loan, but if it's a Parent Plus loan, it's in the parent's name. And if the parents won't co-sign, they may not be able to go to college. All right, that's a problem.
Exactly. And that's why sometimes we see cosigners and it's like their neighbor. Like we see some like crazy cosigners on private student loans. And that's one of the things that we'll get into repayment. But after, when a borrower is out of school, the cosigner is like, take me off of that loan, which is very easy to do after they graduate.
I'm just looking at it from the perspective of, if just let's say I was co-signing for a child's loans, then they're public. When I say public loans, it's public knowledge. Basically, they're going to be on my credit score. That could impede me from being able to buy a house, buy a car, or whatever, because I've got all this debt attached to my name. I could see that as being a very serious problem with people wanting to do that.
Yeah, absolutely. And we even see people whenever they are taking it out, for families that have, a mom and a dad, they're like, okay, the mom's going to co-sign on this one. The dad will co-sign on that one because I can't co-sign on that one again because we're working on buying, X, Y, and Z, and I need to have a little bit less debt. So it's a formula, I'll tell you.
Yeah, that's very tricky. Well, the one I just sent you forward or introduced you to the other day is, they're going through a divorce. And the mother's like, I don't want to be on all these loans. And the father doesn't want to have any part of it. And, the sad part here is the person that loses is the child. And that's just, it's sad. It's sad because they're caught between a rock and a hard place.
It is. I will say there's a lot of, so the FAFSA application, we are not FAFSA experts at Juno, but I can say FAFSA does ask all of those nuanced questions where it's like, are you a child of divorce, or, all of those nuanced questions. And they do give, I want to say, a little bit more loans to people in those hardships as well.
Okay. That's the private side or
Federal.
the federal, but still,
Correct.
it's a really high percentage. Oh, well, the federal is only to the parent. And if the parent refuses to do it, then they're out of luck. The only federal that they can get is Stafford Loans, unless they go back to the school and request some type of financial aid from the school.
Yeah. Yeah.
All right. That's sort of depressing a little bit. I'm just thinking about some examples of people who can't or won't. So you said that the interest rates are in between, and I know this is variable. Okay. And here we are, April Fool's Day, when we're literally doing this. But, here we are in April of 2026. The 10-year treasury somewhere between 4 and 4.5%, which a lot of loans are based on the 10-year treasury. So you said that the Parent Plus loans are hovering at 10%. What are your Stafford loans at?
They're between 6 and 7, which is still pretty high. It's the highest we've seen in a really long time, but better than 10.
So therefore, the private loans are sitting at what, 8, 9 maybe?
So they have a bigger range just by where you're getting it from. So, for example, Juno, we help with student loan origination with private student loans. We can't quote rates because obviously it depends every single year from what our lenders are giving us. But last year we saw in the 4 to 5% range, but that's just because Juno has a very specific negotiation process with our lenders. If you were just going to Joe Schmo's lending service down the street, for example, you're going to see around, I'd say, right in between. So probably like 7 to 8, 7 to 9.
Well, I'm shocked. So then what you just told me is that the interest rate on the private loans, what you saw last year, and if anything, last year is roughly equal to this year, if not higher, it's still cheaper than the federal government subsidized and unsubsidized loans.
For Junos, yes, correct.
Okay, so now this raises the question: advantage, disadvantage of private loans versus the public governmental loans. What are the advantages? What's that?
I said there's a lot. So
Please.
We'll start with the advantages. So
advantages of which?
So we'll start with the advantages of federal. So, and this goes into also repayment, which we'll cover a lot more in the next episode. But for federal student loans, they come with a lot of repayment options, which is a lot of advantages. So you're going to have flexibility in terms of repayment. Also, with federal student loans, you're going to have income-driven repayment structures. You can have the 10-year standard, the extended, the graduate. So you have your pick of how you want to repay this loan, which is awesome. The second advantage is forgiveness events. And that's probably the biggest advantage that we see people be like, I'm taking a federal student loan, even if it's a higher rate, because there's forgiveness options available. And also depends what you're getting into. So for example, we'll talk about public service loan forgiveness a lot more in the next episode, but public service loan forgiveness is a huge one just because a lot of people qualify with that. And like I said, we'll go over this in more detail, but nonprofit workers, so nurses, doctors, teachers, any level of the government, active military, anyone like that can potentially get forgiveness with public service loan forgiveness. So that's another advantage of federal student loans.
All right, question for you. Okay, so is that for the student who graduates, gets a public service, or is it for the Parent Plus loan where they happen to already be in the government, the military, or a hospital? So is it the student or the debtor?
It's whoever's name the loan is under. So for example, the subsidized, unsubsidized, going to be for the student, the Parent Plus, parent. So for the Parent Plus loan, it would be if the parent is working for a nonprofit. So sometimes people very strategically do this, where they're like, my mom is a nurse. My mom is going to take out as many student loans as she can for me, and we're going to work on getting forgiveness after. So some people are like, if they know their parent works for a nonprofit and is going to work for there after they graduate for 10 plus years, they strategically have their parent take it out. But for the other ones, it's going to be whoever's name is under the loan.
I could see that. That's a huge advantage. And then I do know one other forgiveness is if the owner of the loan dies, correct? So
Exactly.
So let's think about that one for a moment. Because if I'm looking at now, is the Parent Plus have to literally be the parent?
No, Parent Plus can either be the child or the parent.
Oh, Oh, the child can do a Parent Plus loan?
No, I'm so sorry. And then if they die, if the student were to pass away, the Parent Plus loan would get wiped away as well.
But is the Parent Plus also available to a grandparent?
No, only, well, it depends who the legal guardian is. Whoever is the legal guardian of the
Guardian. Okay, because I'm thinking, hey, let's get the 85-year-old grandparent who's
yeah.
3 years with terminal cancer to be the one to. That's a tricky little maneuver, but all right, let them be the legal guardian.
Yeah,
Oh,
yeah.
that's all right. I didn't want to go there, but that's kind of an interesting thought. Okay, so what other advantages? I know that has the death benefit, and it's the death benefit of the child if it's the Stafford or Parent Plus, but if it's the Stafford and the parent dies, then there's no help.
Correct, yeah. The Parent Plus is only because it's obviously under the parent's name, so therefore, if the parent passes away, the student doesn't have to pay for it. But it is paying for the student's tuition, so if the student were to die, they do, release that as well.
Okay, fair enough. That's a very, very interesting thing to think about. And this sounds sneaky or backhanded or whatever the case may be. But if you've got two parents and one of them has health issues, sounds to me like that's the parent you want signing the loans. Did I say that?
Good,
I didn't
yes.
say that. No, I didn't say that. Let's just move on because I didn't come up with that idea. Okay. Anyway, moving on. So what are the disadvantages of the federal loans? You gave me the
So
advantage.
the only disadvantages are just going to be what the interest rates are. So, like I said, what you see is really what you get for whatever year you're taking out that federal student loan. So, the only disadvantage I would say would be the interest rate.
Yeah, but you also just told me a few moments. Oh, well, yeah, higher interest rate. Right. Okay. Okay. Well, that's good. Now, there's also other subcategories. Before we go there, because you got the variable versus fixed, but we didn't talk about Grad Plus. That was the fourth category, so to speak, of the federal loans.
Yeah, so Grad Plus, as we mentioned, is another one of the plus loans. So there's Parent Plus, Grad Plus. Grad Plus, exactly what the name entails, is going to be for graduate students only. So you can't be an undergrad taking a Grad Plus loan. You have to be in graduate school of some sort to take that Grad Plus loan. It is in the student's name, so nothing to do with the parent. So is it the student's name? Also, same concept as Parent Plus, so uncapped, which means can cover the rest of the tuition. Also is the same interest rate, so just shy of 10%, so pretty high as well.
Can the parent be the signer of a Grad Plus loan?
No. The only loan a parent can take out on the federal side would be a Parent Plus loan.
Fair enough. So that's what we keep running into is the Grad Plus loans for the doctors. The doctors have these massive loans, and I know we have clients who are approaching their 10-year for the forgiveness. Okay, good to know. Good to know. And so now I guess the other thing is that when you're applying for loans, you also have the ability to pick between the fixed rate and the variable rate. Is that correct?
For private student loans, for federal student loans, they'll always be fixed. For private student loans, you can pick a fixed or a variable. At Juno, we're very big advocates for fixed rates. Variable can be extremely sneaky that we've seen.
Oh, yeah. Well, yeah, we saw that in 2022. And you know what? For a lot of reasons from a financial planning perspective, 2022 was great. Hated 22. 22, we had all of the rocketing inflation, rising interest rates, the markets got smoked and everything else. 2022 did one thing, is it provided the basis for a lot of things that we do as far as to say, hey, look, you know what? This could happen. And you say, this will never happen. It happened. So we could have had these conversations for 30 years, really 40, okay? Because we've been on a decrease in interest rate environment for 40 years, but it happened in 22, and it helps support some of the rationale, to your point, the fixed interest rate. So I would probably be in the same boat because it's something that is sort of guaranteed and understood. You know what your rate's going to be. And it can't go down much, but it can go up a lot.
Exactly. We've seen it start at like 2%, and then by the time they graduate, it's at like 13, and they're like, I didn't even know.
Yeah, and I'll tell you what, that can more than double your loan payment.
Correct. Yep. And, by the time they're, graduating, they're like, I didn't even know what my loan payment was going to be. So they like have no, concept of a payment, since they've never had one.
Well, I'll tell you what, we're at a good breaking point, but I do want to add one other thing, okay, is one of the suggestions that I have for parents who are taking out sizable private loans. The problem here with a private loan is if something happens to the student or even the parent, that those loans are not forgiven. And, I don't know what life insurance the parents may have on themselves, but I'll tell you what, if you think about there being potentially a couple $100,000 in private loans and your child were to unfortunately die for whatever reason, I'm sure beyond the loss of your child, you'd hate to be paying back all those loans. We typically will recommend to the parents who have private loans to be getting life insurance on their children. You can get a 10 or a 20-year term policy on your 20-year-old and you're paying like $10 a month. That's worth the ability to sleep at night. Okay. So, Mackensie, thank you very much. We're going to pick this up in the next episode. To the viewers, thank you very much. We've concluded the first episode where we're talking about the difference between the private loans and the public loans and obtaining the loans. The next segment or the next episode we're going to talk about, now that you've graduated, now we're going to talk about all the different repayment options of both private and public, as well as we talked about there being 20 stinking loans. I don't want to be writing 20 checks or have 20 deposit or ETFs coming out of or EFTs coming out of my bank account. So we're going to talk about that in the next episode. Thank you, Mackensie. Thank you, audience. We'll see you next week on the next episode of Financial Planning Explained.